Well, let's get straight to our second guest on the show, Go Fashion. They reported a rather decent set of numbers in the first quarter. The company saw revenue growth with a marginal increase in gross profits. We have with us Mr. Gautam Saraogi, the Executive Director and Chief Executive Officer of the company, who joins us on the show. Hi, Gautam. Good morning. Thanks so much for speaking to us here on CNBC-TV18. Well, let's get straight to the point. The average selling price was up by close to around 8%. How much of it was because of price increases, and how much of it was because you're focusing on product mix?
Yeah, so I think one good thing what has happened is our product mix has changed considerably since last year. And the 7% ASP change, what you see, is largely driven because of the premiumization of products. So earlier, what our average selling price used to be under 700 is now touching 771. So the price hike would have had an impact of probably 100 bips or 150 bips. But largely this price increase or this ASP increase of 7% is to do with the premiumization of products. We're coming out with many products in jeggings, palazzos and pants, which has driven the ASP.
All right, and I presume that this will continue given the way the trends are moving right now, Gautam. But, has that had an impact on your sales? Because the volume growth for your own exclusive brand outlets this time was down 4%, and same-store sales growth as well was just about 2% for the first quarter. Do you still hold on to the 10% target that you have? And what do you anticipate in the festive season?
See, we are very bullish about the festive season. I think we are going through a downturn in terms of consumer sentiment right now. The entire consumer environment has been a little slow for the last 6 months. But we are very optimistic about the future. So our projection of SSG at a 10% value level still holds good. I think we will be able to achieve that number starting Q3. As far as this 2.5% is concerned, considering how the recent environment has been, I think it's a very decent number. And we're quite happy with what the results are in Q1. And this should start seeing normalcy by Q3 in festive.
Okay. All right. Gautam, what about margins? In the past, when you chatted with us, you said we are looking at around 30%. Now you've delivered close to 34%. You want to up that margin guidance from here on?
No, I think the margin guidance continues to be at 33 to 34%. We will see eventually some uptick in our gross margin. See, currently we are at about 61% gross margin. We will see an uptick in that because of lower cotton prices. We have a lot of inventory which was bought at the higher price months ago. So we have not seen that benefit of cotton prices kicking in. So we're hopeful in the next couple of quarters we'll see another 100 bips increase in our gross margins, which should flow to our EBITDA and PAT margins as well.
So obviously the 30% guidance that you had given, which you surpassed at around 34% in the first quarter, will sustain at around 34-35% for the entire year, right?
We are optimistic that it will be on an annualized basis, it will be between 32 to 33% on an annualized basis.
Okay, 33 to 35%. On a strategy basis, I just wanted to understand, are you shifting focus more towards the exclusive brand outlets? Because I remember the previous quarter as well, you did not supply as much to the large format stores. What is your revenue mix from in terms of channels likely to look like going forward? Currently, about 73% comes in from exclusive, around 21% from large format, and 3% from online. Your thoughts on how this mix will change, and would this have an impact on your margins? I mean, do you make more money when you sell through exclusive brand outlets or vice versa?
See, EBO being 2/3 of our business, more than 2/3 of our business is the bread and butter of the business. The margins are far superior in the EBO compared to LFS or any other channel, as a matter of fact. Our EBO channel gives us a very strong pre-Ind AS EBITDA of 31 to 32%. So it's a very, very profitable business. And we are concentrating more on the EBO business because it's our direct-to-consumer channel. So in the short-term future, we see the sales mix to be the same. We see EBO to be around 73 to 75%, LFS contributing to 20 to 21%, and the balance coming from online. But having said that, in the long-term future, say after 4-5 years, we see to take this EBO mix of 73-74% to about 85-90%. So in the long run, we will see the upside in the gross margins and the EBITDA margins because of that.
All right, let's focus on a couple of other operational parameters. Then your working capital days have improved as you had guided. Inventory days are down drastically out there. And the last recorded number we have of the net working capital days is 136 days. Where do you see this number headed and by when?
See, I think we've improved our working capital days considerably on the basis of inventory. We are further going to improve it. So by Q4, we see our inventory days coming down to about 90 to 95 days. So we will be able to bring our working capital days to about 120 to 125 days. Having said that, at the end of quarter 2, we see our inventory slightly going up because we are going to be entering the festive quarter. But on an annualized basis, we will be able to bring this down to about 90 to 95 days.
All right, inventory days come down to 90-95 days. Overall working capital days come down to 125 from 136 where they are right now. How many stores do you plan to open in FY24?
In FY24, we are planning to open 120 to 130 stores. And next year, we are planning to increase it to 150 to 170 stores in FY25.
All right, and final question, you've earlier said that the top 8 cities will account for a majority of your revenues, but everyone's focusing on Tier 2 and beyond in terms of growth opportunities coming in India itself. Are you tapping that market, and how do the economics of that market shape up for you?
See, Tier 2 has a superb and great potential, but where we are in our journey, we are focusing on the larger cities first. See, we follow a cluster-based expansion model. Rather than spreading our EBOs thin across the country, we like concentrating and opening more number of doors in the same city. So in that journey, we are a little far behind from opening in Tier 3 or Tier 4. So our first focus is to cover the top 8 cities or the top 20 cities first. So that's going to be the plan for the next 2 years. We will be opening in Tier 2, but the larger focus will be in Tier 1 and top.
All right, Gautam, thanks so much for stopping by and filling us in with all those details. The stock is in fashion today, up close to around 4.5%, while the markets are trading mildly in the red.